Good evening, everybody, and welcome to Wealth Mission Group. We are here today to talk about our lending fund, where you get paid the same way the banks do. And we're here to help you understand why a lending fund is the way to invest in today's market without the volatility of a lot of the other things that are going on out there. Here's our disclaimer from our attorney. If you would like to take a chance to read that, we can share this deck again after the webinar. But these are the things that we're required to tell you about investing in any kind of a fund that's out there. And we're just happy that you're here to listen to what we have to say and what's been actually working really well for Samantha and I for the last almost 24 months. Here's our team: myself, Michael Guthrie, my wife, Samantha Guthrie, and our investor relationships partner and specialist, Maria Marks. Between the three of us, we have raised a little over $93 million. We have a little over $2.3 billion of assets under management across 13,205 doors and 48 properties. Most of our investors that invest in the things we bring to the table are repeat investors because they trust what we're doing and what we're up to. And we hope that tonight we'll show you another way to add another bucket of income to your actual portfolio of investments that actually creates income steadily on a regular basis.
All right, let's talk about the real life roadblocks, because even the most successful people are seeing these types of roadblocks that are preventing them from that wealth and that financial freedom. Cash rich, time poor. You've done the hard work. You've built up your wealth. You have a job. You're doing all this. Now managing it seems like a second full-time job. You're constantly monitoring accounts, evaluating strategies, and it's exhausting. There's no time left for you with your families to enjoy what you've actually put your hard-earned money into. That's the fun of it. We're missing out on that part. The paper rich, cash poor, your net worth looks really impressive on paper, but most of it is all tied up. And as Mike has said before, you can't spend your net worth. I wish I could, because I could buy a lot of things with it, but you can't spend your net worth. And in retirement accounts and business accounts, there's no liquidity. Without that cash flow, there's no freedom to pivot or invest in new opportunities. And then with risk exhausted, you've been in the stock market, maybe crypto or any other investments. It's like a roller coaster. While there are potential gains and it looks exciting, the volatility that you have has you worn out. And you're looking for something that's more predictable, more stable, and that lets you sleep at night with that peace of mind. So these are the things that was keeping me from investing, and also that I've heard from other people who are investing alongside with me.
Here's part of the harsh reality is there's a lot of volatility out there in almost every single investment: apartments, self-storage, the stock market that goes through its own cyclical highs and cyclical lows. And if you invest in the stock market and it goes up and it cuts by 50%, it actually has to increase 100% just to get back to even. So while stocks are considered liquid, you're still at the mercy of the market, because you can sell at any point in time and exit, and the loss or profit, it depends entirely on your market timing. Where investing in a debt fund, there's no market timing required. And we're going to show you how that works here in just a few moments. The other thing I wanted to share with you, and I probably should have shared a few slides ago, is we're probably going to be here for about another 25 minutes. And then we'll get to some Q&A. We don't want to take up your whole evening. We appreciate the fact that you've come out on a Tuesday night to spend some of your most valuable, precious asset, which is your time, with us to learn more about what we've been up to. So what is your money doing for you? Let's face it, we all need cash flow. This is Samantha and myself in Miami at a beautiful restaurant, eating dinner at the Versace mansion on our cash flow from our passive income. So why is this important? Why is passive income important? Because most of the time it's consistent and predictable the way we're doing it. It's secured. It's backed by real estate, a real estate asset. It's actually inflation resistant. There's no risk, no boom, and it's independent from the public markets. It's a non-correlated asset.
I love that you talked about where you've been doing, what you've been doing, but let's talk about these three main income buckets. If you think about where your money is coming into and how it's all flowing to you, there's about three buckets that I like to talk about. The first is your active income. And this is where most of us start. This is your job, any commission or sales. You're working, you're getting paid. But the moment you stop working, the income stops too. And most of the taxes that's coming through here, it's time consuming. It's your active income. The second bucket is passive cash flow. This is the game changer. This bucket pays you every month or every quarter. In this case, it's paying you monthly, whether you're working or not. It's income from things like private credit, real estate lending, divided into producing assets. We believe this bucket should be filled early and intentionally because it pays you back your time. And this is where us at WMG are really focusing on because we want to be filling that bucket as much as we possibly can. Then we go into that third bucket, which is long-term wealth. The long-term wealth is all about appreciation and legacy. Owning big real estate like apartments and syndications that grow over time is amazing. We all have it. Most of us came from that, but it's a lot slower. It's powerful when you combine it with cash flow that's coming from bucket two. And that's why it's so good that we have this opportunity, but also why we need to be filling that as much as we possibly can. But let's make it even simpler because it doesn't have to be overcomplicated. We're not reinventing finance. We don't have to make it any more difficult than it needs to be. It's very simple. That's what a fund is. You invest just like many others do by putting money into our fund. We then lend that money to real estate investors who are buying or fixing properties. Then those borrowers pay interest on those loans, just like a bank would do. And then you get a share of that interest every month. It's steady, it's secured by real estate, and it's a model that has worked for decades. And we get to leverage our experience that we've had, our combined experience in real estate, in multifamily and syndications, and we get to use that as leverage for this fund. So again, how it works, we start with the fund. We are looking for properties at Wealth Mission Group are doing the work. We are vetting them. We are underwriting them. We're looking at all of these assets. Then we'll deploy the capital. And we are the first position on that lien, which is really exciting because that means that you get paid back first. And we're managing, we're reporting, we're distributing, and then you get to be this little one person at the end, which relaxing on a beach with that little dollar sign hanging out. That's where you guys are. And I'm loving that part. So this is secured debt. It's not equity. When the borrower pays interest, it flows to the fund and then it flows to distributions to you guys. And in case of a default, the fund takes the asset and recovers the principal before anyone else. So again, you guys are getting paid back first, which is very exciting. Like we said, it's very simple. It's low risk, monthly cash flow, and it is asset-backed investments. So we lend only on real estate that's backed by hard assets like houses, smaller apartments, small flips. And then we have passive income. So you're not on the hook for any of those toilets, tenants, or termites. You're not doing that work for it. And the property doesn't need to sell for you to profit. That's what that bucket 3 was really focused on, is the sell of the property. So you're not focused on the sale, not focused on that part. You're getting that monthly cash flow, whether it sells or it doesn't. Then we have that built-in protection because we are lending. So we've got that property value. So if there's a margin that if anything goes wrong, again, we are in first position. Like I said, less risk. It's very simple. And that gets you your monthly cash flow.
So here's how our investment works. It's all based on the amount of money you're looking to put in. And right now we're finishing up a $2 million tranche that we are looking to fund out by the 15th of June. So money in will be money out immediately because we have some loans that are coming to us right now that we're looking to fund. So you'll actually start making an interest return within the first 45 days of you deploying your capital to us. We'll be deploying it out to the actual fix and flipper in the market. You'll get paid monthly, approximately around the 10th of the month for the interest earned on the previous month. And it's your choice at the end of the 12-month lockup period on your note with us to extend that for another 12 months or redeem your money right back out. And when you redeem your money back out, your cash that you put in comes back out to you as your cash. The only taxable event is the income that you've made on that asset. So your money starts earning money as soon as we get it deployed. And once we deploy it, we will actually notify you via an email that your cash has been deployed into an asset, and you'll start making your interest at that point in time. The other question that's come up on some of the past webinars, say I start with $100,000 into your fund and I get a bonus check or I get another check later and I want to move my amount in from 100 to say 250 or $300,000. All of that money would then move up to the 9% tier, as it would if you went from the 250 mark up to the 500,000. All of the money goes into the highest tier payable based on the amount of money you've deployed into our fund. So just so it's easy to understand how the matrix works, how it looks for you and how it looks for me, is you put your money in. This is the interest rate you'll earn right in the center of the screen. And if you put 50 grand in, you'll get about $4,000 a year out. Not about, that's exactly what you'll get. And it'll come to you every single month at ACH right into your bank account of $333. And say you deployed $500,000, you would make $50,000 a year because you're in the 10% bracket, or $41.66 a month. And we have people doing that right now, and they use that to cover their McLaren payment, just to throw out the car thing. So it's always better to let your passive income pay for your toys than taking that out of your actual principal. So you deserve better. And I love this slide because I have a lot of money for myself and Samantha in multifamily, which are not paying a lot of distributions today. And that's just the timing of the market. It's a space and time. And so we've taken money and started almost 24 months ago and started lending into hard money lending here in Arizona. We only lend in Arizona, just a complete disclaimer, because the repossession laws or the foreclosure laws are beneficial to the lender more than they are to the buyer. I want you all to know that when the money comes in, you get paid first, just like a bank does. So let's stop waiting for someday, because the last time I checked, someday is not actually a day of the week. So at this point, I want to open up the chat to any questions you may have regarding, I think I see one right now. If you invested in a real estate asset, is there depreciation applied as the hard money? There is no depreciation applied, Mark, because we don't actually own the assets. We have a secured title on the asset. We don't actually own the asset at that point in time. I hope that makes sense. So there is no depreciation play in the hard money or the private credit space because we don't actually own the asset. So there won't be any depreciation. Mark, that is correct. This is all hard money or private money credit, private money lending, all hard money. There is no DSCR. There's no equity. We're not taking an equity position in anything. Like we'd said on a few slides back, that there will not be any depreciation. We don't own the asset. We don't have to wait for a sale to trigger your payment on an annualized basis. And another question that just came in, this will be a 1099 type of income for our CPA that would come. You'll get a 1099 at the end of the year for all the upside revenue that you've made in this space. And currently, me and Samantha have a little over $2 million deployed here in this exact space. And this is how I pay my mortgage. This is how I pay my country club membership. It pays my property taxes, and it allows me and Samantha to do the traveling that we like to do. So all of our life right now, this is my job. This is what I do. I actually vetted this out and did it myself. And they're asking for more and more borrowers are asking for more money. So we decided to start a fund around it to bring in people just like yourselves to lend money and make money. So lend money, make money is pretty much the name of the game here. And Travis asks, what rate are we lending at? We're lending it out at 12.5% and 1 point. So depending on how much money you come in with will depend on how much money you make, but that's what we're currently lending it out at. It's not fairly aggressive, but it's an aggressive rate. And what is the size of the average investment? We have them as low as, I think the least amount one we have in our portfolio right now is at $80,000, and our largest one right now is a little over $800,000 on those are two separate assets. And I'm gonna read this question. What is the mechanism for the lender to foreclose on the investor if payments are missed? I know it's a complex question, but what is the summary? The summary is in Arizona, you don't actually even have to foreclose. You just go to the borrower and take the keys. You can actually go through the foreclosure process. It's about a 45-day process if we have to. And that's another reason why we don't lend more than 75% loan to cost, not loan to value of the property, but loan to cost based on what that buyer is buying that property at. Q&A. There's a Q&A section. Yes, Joseph, we issue a 1099. And Travis Becker, I seen your question and answered that in regards to the rate. We're lending it at 12.5% and 1 point, excuse me. And I mentioned Arizona. We are only playing and only lending right now in the state of Arizona because we live here, and it's a lot easier for us to actually visit the properties that we're investing in or that we're loaning on. And it actually allows us to have the relationship with the borrowers so that we have a good working relationship. So we know where they're at, how they're doing, and just we're able to keep an eye on everything that's going on. Are we lending in second position on larger multifamily projects that need cash infusions? No, we are not. We are not lending on any multifamily projects that need cash infusions. That is not our plan, because the larger multifamily that need cash infusions aren't able to actually really pay us a dedicated interest payment on a monthly basis. I've seen some other folks in the space where they're doing a pref loan where they're offering a 10% return, but they're paying 5% current and 5% down the road. And that's because the properties are needing that cash infusion. At 12%, there's another question. At 12%, I assume you only lend to smaller borrowers. Our largest loan to date right now is at $800,000 on a $1.2 million purchase price of a property. So we are doing a little bit larger. That's an 8-unit building that we've lent on. So the larger our fund grows, the more we can play in that larger space. Our sweet spot is in the $300,000 to $500,000 range. The average house in America today sells for right at $400,000. So we're playing in that space. And with Phoenix and Arizona being the 5th largest economy in the world and one of the #1 growing hotspots for tech and chip makers, there is so much renovation on older homes going on in this area that we're having a hard time keeping up with all the loan requests we get. General holding time for a loan. There's no general holding time for a loan. I'll be 100% specific with you. It is a 12-month note to the borrower. If they do not pay that note off or they need an extension, there is an additional point paid for the cash, and their interest rate goes up by 2 points for holding the property more than 12 months. And for the minimum, we're on the minimum. Yes, the prepay. I knew that question, that follow-up was on its way. If they prepay, they owe us a minimum of 6 months interest on that loan to take it.
Hey, Mike, someone was asking how many investors there are on a loan and if you're using an escrow company to handle money and accounting.
We have a CPA firm that's going to handle our accounting and there are multiple investors on some loans. Because if somebody comes in with $50,000 and we have a $80,000 loan, we'll pair that with another 50 and probably take the first 50 in will be the first 50 out, and then 30 of the next 50 will be out, and then the 20 that's left over on that will be the next money out. Because it's first money in, first money out. So all investors are treated absolutely equally. No favorites here. And I like that because then I don't have to promise somebody something and not promise somebody else something else. I'd rather you all know that the first money that comes in is the first money that's going out. And we are paying monthly distributions. So once your money is deployed, say it's deployed on the 15th of May, your first check will come to you around the 10th of June for the remaining 16 days of May. And then from then forward, it'll be a monthly payout. At the present time, we have not had to foreclose on any of our borrowers. And I think that's a great question. The reason why is we're only loaning up to 75% loan to cost. So that borrower already has a quarter of that property's skin in the game. And the last thing they want to do on a $200,000, $300,000 property is lose $75,000 to $100,000 of their own money in the process, while we would make that additional. And as a statistic, less than 0.1% of these loans ever go into default. We have a number of friends that do this in other states, and their default rate is less than 0.1%. Why only a 1% origination fee and increase the share with the lender? We're already charging a high enough interest rate. We're not trying to gouge anybody. We want to make sure that they have skin in the game and that they're able to perform. So that's one of the reasons we charge it. There's some of them out there that are charging 2 and 3 points, but we get the phone calls from those similar borrowers that have been doing that with those other folks that have gotten a little bit out over their skis in their greediness. And that's just my opinion. I could probably be leaving money on the table, but I like to do win situations where you win as the investor, we win as the lender, and they win as the borrower. So we all want to win here so that we can actually have repeat business and do multiple projects with the same borrower over and over again. When they get a good deal, they're not going to go shop you all over the place. But if I come into there and go, I'm going to charge you 15% and 3 points, they're going to go shop me and see if they can find a better buyer. What's the difference between loan to cost and loan to value? Loan to cost means if they're buying that house for $100,000, we're loaning on the cost. If that $100,000 home is actually worth $150,000 because they're buying it in the foreclosure market, kudos for them. Now they even have more equity in the property. That doesn't mean we're going to go deeper with them. We're going on what they're actually paying for the property. Loan to cost. How are we vetting? Are we vetting the borrowers required to have a specific net worth? The borrower's required to have enough money to execute their business plan with their 25% down. We're more invested in the value of that property than we are in the value of that borrower. Yes, we watch the borrower to make sure that they're able to complete their project and get in and out of the asset. But it's less about their credit and their ability than that it is in the property and their ability to repay the loan. We are not, Mike Carter, I think good question. We are not loaning on the renovation costs. That's part of what these fix and flippers are actually bringing in as additional investment into the property. I'm not going to get into the credit score because it's more based on the value of the property and the borrower's ability to execute their business plan on getting the renovation completed. We don't, a CMA is an opinion of value. It's like going on to Zillow or Trulia or Redfin to get an opinion of value. We actually get an appraisal on the property, and the appraisal 99 times out of 100, I'm not going to say that many because we haven't done that many loans. All the time, the appraisal actually comes in higher than what the borrower was actually buying the property at. How do we know exactly what asset you are deploying our funds into and when exactly? Is there a way to know? We actually have a portal that we are actually, cash flow portal is our portal. We are going to post all the properties that we've actually lent on or that we're actually lending on there. And when we send you out your notice of deployment of your personal capital, we can actually tell you, we're going to give you the city and state, the city of that property. I'm not going to give you the actual address because we don't need you driving by the address. If it comes down to where we actually have to have the address for you to work with us, we can have a one-on-one off call and sign some NDAs in regards to that. And a promise to never go to the property and show up as I'm the lender on this asset. So we don't need you showing up to talk to our borrowers on a regular basis. Yes, we do. Hey, I just answered the question in my head. I'm going to say it out loud to everybody. If we have a foreclosure, do we have subcontractors in place for the property to do the proper rehab and sale? We do have access to contractors. We have access to realtors that have helped us on some of these, and they actually bring us contractors to get the property up to speed if we need to. We haven't had to repossess a property at this point, knock on wood. But if we had to, there's actually more upside for us on that asset. We're not in the business of loan to own. We're in business of loan to grow. We're helping you grow your money, helping the borrower grow their database, or not their database, but their wealth by doing the fix and flip. Do accounting needed to enter Mission Wealth Group? I'm not sure what that question means. Who is named on the deed of trust, Steve? That's a great question. Wealth Mission Group will be named as on the deed of trust. And I'm not sure if William was asking if do you need to be accredited to enter the Wealth Mission Group? As an investor, you need to be an accredited investor to invest in our fund. Yes, you do.
If you have any questions on whether or not you're accredited, though, please book a call because more than likely you are accredited. We have ways to verify accreditation too. So just book a call and see if you are unsure.
Ton of great questions tonight. Really appreciate everybody being
on them.
This is great. If you're interested in joining us on the Wealth Mission Group and our fund to get money out there on the streets and get it working for you, so it's making more than the 1/10 of 1% that mine makes, my little bit of money that I have at Chase still, scan the QR code in the bottom corner of the screen here, and it'll take you to our website where you can book a call with myself or Maria, or you can invest now. You go right straight to the portal, fill out the documentation, and get your money out there and get it working for you immediately. And I'm going to stay on for a couple more minutes since the questions have slowed down. If there's more questions, please put them in there. We do not put insurance on the property. Great question, Steve, and I'm glad you asked that. The borrower is required to have insurance on the property, and we are actually named as additional insured. Thank you for showing up tonight and spending some of your precious, valuable time with us to learn more about what we're up to. We're looking forward to helping a ton of people continue to grow their wealth through lending, just like a bank. I mean, just think about when you put your money in a bank, the bank can actually take your amount of money and lend it out 9 times what you put in. And then they pay us 1/10 of 1%. Be part of the difference and get your money out there on the street and start making a difference for your family. Thank you, Brooke. Great to see you here tonight. Appreciate you always. Do you see any other questions, Maria, that I may have missed?
No, I think you got them. And just make sure when you do scan that there is the call in 2 weeks. We are talking about how we can get you more consistent cash flow. So it's going from performance play to passive paychecks. So if you think about it, if you are coming from a commission-based W-2 or you've never gotten a bonus of any kind and you can't really rely on month to month for those amounts, this is the webinar to be at. We really want to talk about how we can get you those passive paychecks consistently in your bank account every month. So you don't want to miss it. We're so excited that you chose. Spend some time with us. We know your time is valuable. We don't want to keep you on for too long. If you have any more questions, please book a call with one of us. We'd love to talk to you more about how you are funding your passive hobbies and what your wealth mission is.
Absolutely. So one more time, I just want to thank everybody again for showing up tonight. To book a call with myself or Maria or get next steps, scan the QR code in the lower corner and away we go. And we are here to help you. And I want to thank you again for showing up on a Tuesday night. Have a great evening. Thank you, everybody.